A second wave of inflation is about to begin, just like happened during the 1970s, as we are following the exact same playbook. So what playbook is this? What patterns can we look at to see what's coming ahead? First, we have to take a look at what started in 2020. The money printing started in March of 2020. Simultaneously, asset prices started their historic run higher. However, prices of goods and services didn't even get back up to their previous average of 2.6% until a year later, March of 2021. And after that, they finally skyrocketed to their recent historic highs in June of 22. Right around then, the Federal Reserve became scared that inflation would just run away from them, and so they started to tighten to pull back in on inflation. They began to reduce their balance sheet and raise interest rates. And in lockstep, the rate of inflation started to fall as well. Now, prices, just the rate of inflation. However, every time this cycle plays out, the pressure goes to the one who loaded up on the most debt. In this case, that's the US government. Federal government had a historic spike in trillions of dollars in new debt. They borrowed that massive ton of money to pay out cash into the economy. And they were borrowing while interest rates were near zero at a record historic low. That provides false confidence because right now the debt is cheap, but what happens in the future when the debt gets more expensive and you have to borrow more in order to pay off that old debt? Well, as a result of inflation sticking around above the Fed's target and them having to keep interest rates historically high to keep on trying to fight inflation, the federal government is now rolling over a bunch of that previously cheap debt at prices they can barely afford, which means when the pressure builds, they either are going to have to default or the Fed's going to step in and ease for them. Now, in the past, the way they've done this easing once everything starts to hit again is through lowering interest rates. As you can see, they did this twice during the 70s, and both times that reignited inflation. Now, I'll show you why later, but this time around, they're not going to lower interest rates in order to ease the burden on the government. This time, they're going to do that through debt monetization, in other words, quantitative easing, or just printing money to lend to the government. This will cause the Fed's balance sheet to rise, allow the federal government to continue borrowing more and more. They're going to be spending that new cash into the economy, and that's going to push the rate of inflation back higher yet again, which means the rate of inflation is following the same path as it did during the 70s, even if it's for slightly different reasons. And we're already starting to see this unfold right now. Remember in 2020, before the inflation hit goods and services, asset prices anticipated that future inflation and started to skyrocket. This is known as the Cantillon Effect, and it's happening right now. The price of gold has broken out from a multi-year-long consolidation pattern and is now at all-time highs. Silver has also broken out from a multi-year consolidation pattern and is on its way much, much higher. Bitcoin is also now consolidating around all-time highs in what looks to be a bull flag formation, indicating it's about to head much higher. Stock market indices like the S&P 500 are also at all-time highs, and we could go on and on and on. The fact of the matter is asset prices are sniffing something out. Now, this is already creating tons of opportunities to make money both on the long side and on the short side of things. These are opportunities that are asymmetric in nature, which means that the most you could potentially lose is much smaller than the most you could potentially gain. GDX is a gold miners ETF, and recently I sent out one of these asymmetric opportunity alerts to members of Heresy Financial University when GDX was trading around $26 per share. Currently, they're already up 27%, and that move is just getting started. Receiving reports of asymmetric opportunities like this is just one small thing that can make you a ton of money that I do for members of Heresy Financial University. But if you're interested in learning how to do this yourself, then I want you to mark a date on your calendar, April 25th at 7 p.m. Eastern Time. I'm going to be hosting a live masterclass where I'll be covering the asymmetric trade, which is what I think one of the best kept secrets in all of finance. These types of asymmetric trades are the money makers for some of the biggest investors and traders, the legends throughout recent history. People like Ray Dalio, Nassim Taleb, Bill Ackman, and Michael Burry. I've personally been testing and using this strategy in my own account to take home some big gains over the last 8 months. And I'm going to be sharing everything I've learned with you. It's completely free. And with all of the uncertainty coming up this year, like changes in interest rate policy, elections, geopolitical uncertainty, this is one you're not going to want to miss out on. All you have to do is click the link in the description below, enter your email, and I'll see you there. So just like happened during the 1970s, where the rate of inflation increased until they started to tighten down on it, and then it fell, but that started to cause other problems that they needed to bring some more easing to fix, caused a reignition in inflation. The exact same pattern is unfolding right now. But I can tell you're not convinced. You're sitting there thinking, everything is great right now. I'm making good money. Everybody I know is making good money. Bidenomics is working fantastically. Yes, inflation has stalled a little bit, but it's still gonna be heading lower. The jobs market is awesome. What could possibly cause something bad enough to cause more money printing that would spark a reignition in inflation like this? Well, I'm glad you asked. And I'm glad you brought up the jobs market. Let's take a look. First, job growth in an inflationary environment can contribute to what economists call the wage price spiral. Even without new money currently entering the system, both wages and spending can rise in lockstep with each other as long as the savings rate doesn't also rise. Now, this would require a rise in money velocity. And would you look at that? That's exactly what we've been seeing for the last 2 years now. Velocity is not necessary to cause inflation, but it can be sufficient. Kind of like a hammer is not necessary to drive a nail, because you could use a rock. But if you do have a hammer, it can definitely be sufficient to drive that nail. So now you're saying, well, okay, doesn't really matter though, because yes, the wage price spiral is a thing. Jobs growth can contribute to price increases, but people should just be happy that they have the jobs in the first place. Not so fast. Let's dig deeper. Because recently the jobs report for March came out and payrolls jumped by 300,000 and unemployment dropped to 3.8%. The job growth was well above what was estimated of 200,000. But here's the thing. Most of the time, these jobs growth numbers are revised down after the fact. In fact, in the last 14 months, 9 of the jobs reports have been revised down, bringing the total revision to negative 229,000. And if we look at where these jobs actually are, the number 2 biggest area of job growth is government. And the number 1 biggest job area of growth is healthcare and social assistance, which is also just basically government. And in fact, government payrolls are actually being revised up after the fact, which means that most economic growth in terms of jobs that we're seeing right now is just government jobs. These are jobs that would not exist outside of the force of law, which means by definition, they are a drain on wealth and are not contributing to economic growth. At best, they are neutral because they are being funded through wealth transfer. Private jobs, on the other hand, have the capacity to create wealth and are funded by the growth that happens in the economy. This means the job situation right now is the worst of both worlds, because number 1, on a net basis, when you look at the overall economy, the job growth that happens primarily in the government recently is a drain on real wealth. But number 2, there's still jobs and it's still people getting money, which contributes to the wage price spiral. So we're getting the liftoff in prices without the accompanying increase in wealth on net in the economy. Okay, so forget all that. If that was true, then the market wouldn't be anticipating the Federal Reserve to cut rates soon. And the market is expecting the Fed to cut rates. Right? Not so fast. If you've been around here for a while, you know that I've been saying for a long time that the Federal Reserve is not going to be cutting rates the way the market expects it to. Last year, the market was pricing in that the Federal Reserve would lower rates by a ton and very frequently. Not only has that not happened yet, but the tune has now changed. Recently, Powell was speaking about the Federal Reserve's plan with inflation, and he repeated that they're going to actually have to wait and see. To further clarify this, a few days later, the Federal Reserve's Barkin came out and said we need confidence in the path of inflation moving lower in order to be able to cut rates. And to really drive the point home, a day later, the Federal Reserve's Kashkari came out and said that if we continue to see inflation moving sideways instead of down, then he would question whether or not any rate cuts would happen at all. And that's why I said earlier that this time the Federal Reserve is not going to be cutting rates to ease the pressure on the biggest borrower, because they're afraid of exactly this happening following the 1970s playbook, when the Federal Reserve lowered rates in the early 1970s and the mid 1970s, causing a new resurgence of inflation. But just because they're not going to repeat the exact same mistake through interest rates doesn't mean they're not going to refuel inflation in another way, because the federal government has a massive load of over $34 trillion of debt. And every day they're having to roll over massive amounts of that debt at much higher interest rates than when they originally borrowed it. This year alone, they're gonna have to borrow over $10 trillion worth of debt when you combine new debt and rolling over old debt, which is all borrowing happening at historically high interest rates. This is causing interest payments alone on the national debt to become one of the biggest line items on the budget. It's already over $1 trillion. When push comes to shove, the Federal Reserve will have to step in and be that lender of last resort to the government. After they've sucked all liquidity out of the system, and there's nobody left to borrow from at the rates that they can afford. The Federal Reserve will step in, print the money to buy that debt. In other words, be the lender to the government indirectly through the banking system. They'll grow their balance sheet once again, and all that new money being lent to the government to be spent out into the economy will push back up on prices. And the biggest thing to note is that asset prices are already expecting this, with gold at all-time highs, Bitcoin all-time highs, the stock market all-time highs. And in order to try and stop the inflation in goods and services, the Federal Reserve will hammer down on the economy even harder by not lowering rates for you and I, which means not only will the economy be paying higher and higher prices for assets, higher and higher prices for goods and services, but also continue to pay higher and higher prices for debt. The Federal Reserve is already signaling to the market what its plans are, keeping interest rates high, while job growth will continue to add fuel to the fire. And don't forget to sign up for my asymmetric trading masterclass using the link in the description. You don't want to miss out on learning how to take advantage and profit from all the crazy things happening this year. As always, thank you so much for watching. Have a great day.